You know, there are two words when you deal with the word real. And real in the financial industry always is talking about inflation. What did you really get after the inflationary effect? And most of our lives, we've only heard the discussion of inflation. That's prices rising. But there's this scary monster in the closet. It's called deflation. And it scares the Federal Reserve to death. Let's talk about the difference between inflation and deflation. Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Daren Hardesty.
Happy to have you along. Hey, you know, I grew up I was born in the late 60s. So I got to experience, late 60s, mid 60s, who's lying? I got to experience this rise of inflation, the gas lines that we had, you know, some of the crazy stuff that was going on. I got to watch this peak of inflation, which was actually 1980. The average 30-year mortgage in the United States, that's your pop quiz for the day. What was the average 30-year mortgage, Daren?
In
1980.
I think it was around, 17%?
18%, pretty close. I'll give you some credit. Ronald Reagan had just taken office. We actually had an engineer who had 22% was his 30-year mortgage rate in Indianapolis. Now, why, Daren, buddy? You're a math guy, right? You're a former math teacher. Mm-hmm. Why in the world do you suppose anybody would pay 22% for a mortgage?
Well, I think the world would go crazy if that was the case today. People wouldn't understand. But I know that mortgage interest is tax deductible, so that would possibly be some kind of a write-off.
So when you and Morgan decided to get your house today, mm-hmm. right, you did it because you were getting a tax deduction.
Absolutely not.
Why did you do it?
We wanted a home to live in.
Why?
So that we could raise our family.
So you had 3 little kids and you needed a place to put them to sleep.
Absolutely.
Right. And that's what mommies and daddies do. Right. So there is a big believer that the average consumer does stuff based on the interest rates. Right. Mm-hmm. Many economists believe that is purely the driver. The Federal Reserve used to believe that they could raise interest rates to slow down the economy, like anybody wanted it slowed down. Right. But what you have inside of inflation, right, anything up to 4.5% is really deemed okay. Once you go above 4.5%, people start to quiver a little bit, and you start to hear this word hyperinflation, right? Mm-hmm. You know, which has been a large part of my life. Now, I am not a conspiracy theorist at all, but I will tell you that I believe inflation is much higher than what you hear in the CPI. It's based on 2 things: goods and services. Right? I think services are accelerating at a much higher rate than the inflationary rate that we hear, mm-hmm. right? And products that you're buying for your kitchen and everywhere else are deflating because we can get them from we can get a couch from China. Right? I can't have my hair cut in China.
Correct.
Right? The people who help with the yard, right? You know, any of those services that you have to be right here. Right. So let's go ahead and hit this. So what is the difference? And if you were going to explain this to your kids back at school, mm-hmm. what is the difference between inflation and deflation?
If I was explaining it, I would start with just the value of the dollar. You would say, how much can this dollar buy? And if you're experiencing a lot of inflation, your dollar its purchasing power becomes less. It's just not going to be able to buy as much as it did before. Where deflation, your dollar is going to be more valuable. It's going to be able to buy more things than it did before. But there's consequences to both of those things.
So if that's the case, that was a pretty simplistic and accurate answer, but why does deflation scare the heebie-jeebies out of the Federal Reserve?
Deflation means that the people who are providing services or goods are going to be making less. They're not going to be able to stay, the last time we experienced major deflation was in the 1930s. And we all know that in the 1930s, the economy just wasn't doing too great. So I think keeping the engine roaring and making sure that people are able to spend their money, people are able to sell their goods and services, and make sure that, we're constantly moving up is always a good thing. If you start to deflate and you make that dollar more valuable than it needs to be, then that just kind of drags the rest of the economy down with it. Just because you have too much, and then people, they can't sell their items to have a profit, and only bad things come from there.
Tax revenues fall, mm-hmm. wages tend to fall, nothing good comes from it. But the biggest thing, and I will tell you, the Federal Reserve, I think, is delusionary in their ability to believe they can control the economy. but they certainly try. And they have a mandate from Congress to attempt to do so, right? To have what they call full employment and appropriate price appreciation, right? And so the belief on in Capitol Hill and in most business schools is if I raise the interest rate higher, by definition, I will slow the economy, right? And that might work when you're younger, but it doesn't work. The less debt you have, the less you could care about the interest rate, right? I mean, if you're carrying a lot of debt on a credit card, then you care about this, right? But the older you get, the less that impacts the decisions that you make. There is no known mechanism to fight deflation, right? When the cost of items go down, by definition, I have more discretionary income. How do you speed me up? You can't put more money in the system. I've already got money, right? There is no known, and so now you just kind of sit there, you twiddle your thumbs, and you pray, that something is going to drive you out of this. And so, that really is the difference in terms of what's going on. You can, we used to say you can only drop interest rates so far, right, to zero, and now we have negative rates.
Yeah.
So
Defeated that.
That's kind of yeah.
Well, and I've heard an interesting statistic. Between checking accounts and money market accounts, there's somewhere around $8 trillion in cash sitting in those accounts right now. Is that that much cash on the sidelines, receiving all this stimulus money, all these things that are coming out, all of the people who went through 2008, experiencing what it felt like to have that long period of time of the recession. Will that have a deflationary impact by having that much cash that's not being put into the market actively or into the economy actively?
The interesting thing is if you put 30 economists in a room and ask them that question, you'd have 37 answers.
I bet.
Right?
Yeah.
I mean, they won't even agree with themselves, right? I mean, there's a lot of reasons to speculate. The answer to that question is both yes and no. And it really does come down to who gets the checks, right? So, for those of you who've paid attention to the news lately in the marketplace, you've heard a lot about this place called Robinhood, and what happened is we watched a lot of people open up accounts brokerage accounts for the first times in their lives that happened to be identical to the amount of stimulus money they got, right? And so the money went into our market, pointing out and pretty much arguing that they didn't need the money, right? It went into my world, into the investment world, and created some havoc, for the record. But there's other people who really, really need it. I mean, we live in a world, and every now and then you'll hear an economist talk about the difference in the separation of wages, right? That the rich are getting richer and the poor are getting poorer. That has perhaps never been so true as right now.
Yeah. And
it's because of the wealth index. It's not the income index as much. It's the people who already have assets who are watching a market that's going up, 4 or 5% in a quarter. And obviously that doesn't happen all the time, but it's been happening, right? The market even had good returns through 2020. And so the people who had assets have more, right? And people who are starting out have less. That by itself creates what should be inflationary pressure, but you've got to get people to want to buy it.
Yeah, and it's interesting, just the storm, if you will, of COVID and not being able to spend money on discretionary things. Lots of our families that we've talked to, it's just you can sense it. That they want to spend their money, they want to go out, they want to travel, they want to do things, and so I imagine there will be a point where the world kind of opens back up at some point, and all those dollars are going to find a home, and hopefully it'll be a nice response. But it's just interesting how all these things are kind of circling together and how it's going to impact long term.
I hope you're right.
Yeah, me too.
Othello is our rescue lab that we've had for the last 8 years, and he's had Daddy home now for 12 months. And he gets anxious when I come to the studio to do this. I mean, you can just watch, and he'll be waiting at the door when I get back. You contrast that to 2019 when I was gone 6 or 7 days a month, right? He doesn't want me to go. Barb doesn't want me to go, and I'm not sure I want to go.
Yeah.
Right. We've got it's kind of like Google is now a verb, so is Zoom.
Yeah.
right?
Yes.
It's time to Zoom. I Zoomed 4 times today. And I think the world has just changed a little bit. So I can't answer that. Whether that $8 trillion comes rushing back into economic expenditures or not, I don't know.
Yeah.
But you did ask a question on here, which I thought was interesting. Is it better to buy a home during an inflationary period or a deflationary period?
And that all depends on where your assets are at. If you are cash heavy, if you have a lot of cash in the bank, buying a home in a deflationary period makes a lot of sense. You're going to buy it more of a discount. Your dollars are going to go a little bit farther. The value of the home is probably going to be less than what it actually is in a healthy market.
And typically the interest rates are lower.
Yes.
Right?
So it's for some people, it would be a great time to buy a home. For other people who, need to finance the majority of the home or, the full amount or, just over the full 80% over the 20% down, it probably is relative to the homes that you're selling. The homes that you're buying is probably still relative. But if you're in a position that you could use more, you had more cash or you had more leverage, or you could buy a better discount, then I think a deflationary time would be the better time to buy a home.
So given the choice between renting or buying right now, you would take the buying.
Well, the market's hot right now.
Right.
And so
You've heard people say that about the stock market the last year of your life.
Yes.
Right? There is a difference between an economy and a market. I am always leery when I say something is
I know,
hot.
you're right.
And
It's interesting though. My wife and I, when we bought our home in 2014, the economy was improving, so we were getting to a better place. So we've seen the equity grow in our home because of that, and we weren't in at the best time, but we still have really reaped the reward of getting in 2014 versus getting in 2018 or 19. So,
But that's because you haven't sold the one that you bought in 2019 yet.
Correct.
Hey, you're listening to Consider This program. You want to know what fun is on an allocation day? On Mondays, we have this battle with our team at 1 o'clock where we really go head to head to try to shake these deals out to understand, what our team is thinking and how we're going. And we bring in a bunch of information from other economists and other sources. And then we just kind of run it around and chew on it, if you will, to come up with the right decisions to take care of the families that we serve. If you would like us to be that person for you, give us a call at 800-928-4001. We're more than happy to sit down and talk to you.